Mehrsa Baradaran, The Color of Money, Black Banks and the Racial Wealth Gap. Embark on a thought-provoking journey as we explore The Color of Money, Black Banks and the Racial Wealth Gap, by Mehrsa Baradaran. This book summary will delve into the historical and economic forces that have contributed to the immense disparity in wealth between Black and white Americans. Examine the challenges Black-owned banks have faced in the fight for equality and the impact of segregation on the economy. Discover how political figures and activists, from Frederick Douglass to Richard Nixon, have endorsed Black banks as a means to uplift Black communities. Ultimately, we'll scrutinize the reasons why these institutions have struggled to overcome their historical burdens.
Wealth inequality among Black Americans. Despite decades of reforms, Black Americans still face the wealth gap, which has caused present suffering due to historical injustice. The 2008 financial crisis compounded their problems as they possess little intergenerational wealth. Although Black-owned banks have long been touted as a solution to this problem, they have struggled to make headway in a deeply segregated economy. Many notable figures from Frederick Douglass to Malcolm X have emphasized the importance of these institutions, and even some political leaders have supported them. However, the few Black banks established over the years have been unable to break free from a history of oppression. The hidden complexity of Black banks. Black banks were established to cater to the needs of underserved Black residents and businesses, but the reality was more complicated than expected. The economic realities of the Black neighborhoods made lending to Black consumers and entrepreneurs riskier, which resulted in Black banks holding more loan loss reserves than other banks. Furthermore, Black customers typically made small deposits, which created higher costs for Black banks than for their competitors. As a result, Black financial institutions invested mostly in low-yielding government securities, redirecting their community's money to Washington, D.C. Sadly, these banks were just another conduit for sucking money out of Black communities and into the mainstream economy rather than helping keep Black wealth in Black neighborhoods. The unintentional decision by Black bankers to use the incomes of their customers to undercut the ghetto economy by investing in the outside community made the situation even worse. The economic exploitation of enslaved people. Enslaved Africans were viewed as property and used as collateral for loans, with an estimated collective value of over $1 billion. Despite the economic gains created by slavery, enslaved people themselves never saw any profits. Black individuals in the North were prohibited from accessing the banking system and could not sue white customers or competitors, leading them to rely on other African Americans for credit. The Freedmen's Bureau Act promised newly freed enslaved people 40 acres each, but it was ultimately not fulfilled due to backtracking from President Andrew Johnson and violent opposition from former Confederates. As a result, Black Americans were left marginalized and without assets or the ability to vote or acquire skills, ultimately forced to grow cotton through sharecropping. The Freedmen's Savings Bank disaster. In 1865, the Freedmen's Savings Bank was established to help Black people enter the financial mainstream. Marketing the bank as a government arm resulted in a tremendous influx of depositors, leading to $75 million in deposits in just 10 years. However, the bank was run by white bankers who viewed it as a source of capital for speculative ventures rather than a means of supporting Black people. Despite adding branches and advertising campaigns to attract more investors, an economic crash in 1873 was devastating, causing the bank to close in 1874. More than 61,000 customers lost almost $3 million, leading to a widespread loss of faith in the federal government and distrust of banks among African Americans. The struggles of Black-owned banks. Despite a significant increase in the number of Black-owned businesses in the U.S., Black banks faced many challenges in the early 20th century. They were limited to serving a small clientele, which made it difficult for them to grow and compete with mainstream banks. Additionally, their deposits were riskier due to the smaller size and frequent withdrawal. This hindered their profitability in lending capacity, as they struggled to maintain high capital ratios. The True Reformers Bank in Virginia and the Wage Earners Savings Bank in Georgia were two examples of failed black banks, due to issues such as personal relationships overshadowing stringent underwriting. Even into the 21st century, black banks continue to have a high failure rate. Despite these obstacles, black-owned banks have played an essential role in providing financial services to underserved communities, and some have remained successful for decades. Struggles of black business. Durham's Black Business District, unlike Tulsa's Black Wall Street, remained prosperous because of its self-sufficiency, the overall prosperity of Durham's economy, and the successful Mechanics and Farmers Bank. Meanwhile, Tulsa's African American community was attacked due to white resentment against their success. Tulsa's black capitalists displayed their wealth openly, but Durham's black individuals kept their wealth concealed. The survival of the bank and the growth of black businesses in Durham reflected a community's economic wellness. The struggles of black banks. The Great Migration brought hope for freedom and wealth to black Americans. In their search for success, many turned to black banks. However, as black neighborhoods suffered from segregation and white flight, the promise of financial security proved fleeting. The Binga State Bank in Chicago, for instance, quickly grew as Jesse Binga bought homes from white families and resold them to black buyers. But when the stock market crash of 1929 hit, white lenders refused to extend credit, and the bank closed, causing customers to lose their deposits. Such events highlighted the challenge black banks continue to face. They lack the self-sustaining system of white banks and only serve as a platform for black depositors' money to move into the general economy. Despite their limitations, black banks remain vital in providing access to capital and financial services for communities long underserved by mainstream institutions. Economic reforms and their unequal impact on black Americans. The economic reforms of the Great Depression benefited poor white people but excluded black Americans. Laws mandating minimum wages and Social Security did not apply to black Americans in domestic and farm jobs due to the powerful Southern Bloc in Congress. The Federal National Mortgage Association and the Federal Housing Administration expanded homeownership opportunities for white people while excluding black people. Additionally, Public Works Administration grants funded roads and bridges that negatively impacted northern black communities. The Federal Deposit Insurance Corporation imposed capital requirements that locked black institutions out of eligibility for bank charters. These inequities led to subpar living conditions for black Americans. Nixon's failed black capitalism. In the 1960s, federal initiatives promised to end racial prejudice in America. However, these reforms did not create opportunities for black Americans to grow their wealth or access credit. When Nixon became president, he touted black capitalism, a self-sufficient approach that did not address decades of government programs that oppressed African Americans while helping white citizens. Nixon's proposals accomplished little but appealed to black militants who accepted this idea of self-sufficiency. The sagas of the Freedom National Bank of Harlem and Shore Bank, both of which served black clients, show that not much has changed when it comes to black banking. Despite their customer deposits, the FDIC did not pay depositors more than $100,000 until Congress acted. Shore Bank applied for a bailout under TARP but was denied, while major banks with Wall Street giants received TARP money. This reveals how Nixon's black capitalism failed to address the systemic inequalities continuing to hamper black families' ability to grow wealth.
In conclusion, The Color of Money provides an insightful examination of the racial wealth gap in America, highlighting the limitations of black banks and uplifting the black community. The book uncovers the deep-rooted historical issues, systemic discrimination and segregation, and the failure of political initiatives to address wealth inequality. Black banks struggled with unstable depositors, lack of mortgage businesses, and the further redirection of black communities' money to the mainstream economy. The array of challenges faced by these banks serves as a testament to the complex and intertwined nature of race, economics, and politics in American history. Through this understanding, we can better contemplate the path for progress, integration, and bridging the racial wealth gap.